Hi, I'm Peter Rose, founder of Longwood Currency Trading. When do you exit your Forex trade? When do you get out? Well, you'd think, well, to hit your stop or whatever. Anyway, there's a little bit more to unfolding the onion on that one and taking a look, and that's what I'd like to do. However, no coffee, and the reason for that, as I have to fix that, our Keurig coffee maker shit the bed the other day, and it just won't work. We called the company, we did everything, and they said, nah, it's dead. Well, it shouldn't be dead. It's only 3 years old. Come on, please. Okay, we can send you another one. It takes 7 days to get here. 7 days without the coffee maker. So we're limping along with some rustic methodologies right now. So I've got to do that, make the coffee first, then we can talk about when to exit a Forex trade. So let's get on with making this cup of coffee so I can have that while I'm talking with you. Water's on, and it's just going to take a while to go. A watched kettle never boils. Alright, so I've got to put the right amount of water in this measuring cup. A pour has to be done just right according to Sue's son's instructions on how to do this. So get that poured in a little bit. I guess that's the primer part. Let's pour a little more water in and we'll sit here and watch it do whatever it's going to do. Okay, that's it. Done with that. There it is. Let's try it. That's okay. I can actually talk now about trading. All right. Well, we're in position now. I wanted to do this in the kitchen today. It's very pretty out. Well, it's December of 2024, and we have rain today, and it's chilly and cold, and a little different than the view out the window the last couple of times I've done videos because it's been sunny, and you can't even see out when the sun is shining. So we'll see how this comes out on film. In the meantime, when do you get out of a Forex trade? Look, we talk a lot about profit targets, right? We're going to set a profit target, 10 pips, 200 pips, whatever it is. So what do? You set a stop there. Yeah, limit order. In many cases, you can do that. But what happens if the price, if you misunderstood the price and it doesn't have enough juice, special magic juju stuff that will take it from where it is and price action and move it and get to that profit target so it bangs on your takeout limit order? What happens then? Well, your price falls back. It could fall back 4 ATR before you stop it out. Well, you're running it. You say, well, I'm running a stop. Okay, how far back are you going to run your stop? 10 pips, 20 pips? How far do you want that trade to go? And I'm not talking about day trading here. I'm talking about a runner trade that has gone on through where you have that overnight carry trade situation where you have to put a trailing stop on there. Once you put a trailing stop on, the decision process of exit methodology is done. It'll exit when it hits that trailing stop. Just as it would have been the end of it if it would have hit your profit target. When you're trading, day trading, you have to set a profit target that's based on the feasibility of that currency pair during that particular time frame, during those particular conditions, will have that special ability to get to a certain profit target, a number of pips, okay? Not dollar values, but pips. So you're looking at this thing and you're saying, well, today I think it could get 20 pips, right? I think it could get 40 pips, right? I think it could get only 8 pips. The first decision really that you have to make in this exit stuff, and that's way up front in your thing, is do I have a viable profit target? And what that means is, do you have any free real estate, as much free real estate as you need in order to make your optimum number of pips per day that you would like to have? You can make a living on 5 pips a day. You really can, if your bank is big enough. But even a 2-lot at 20 bucks a pip, 10 bucks, that's 200 bucks. A lot of people don't make $200 a day. So when you're looking at your profit target, you're really not looking at profit target. You're looking at how far will price go before it starts to run into some sort of resistance. And that kind of resistance, obviously, is past price action that's created structure. We all know how to evaluate those, and we'd call them, on a long position, we'd call it a resistance zone. I think resistance zones are misnomers, but for our purposes, they certainly will suit the bill. There's something there that says, in the past, price has not been able to go beyond that. You don't want that to be a weak zone, because you want to be able to get as many pips out of the position as you can. So just because you've got a line that has one touch to it doesn't necessarily indicate anything. So you have to have some skill in understanding order flow and past order flow, in particular of the particular currency pair that you have, and the time of day that you're trading, and all the other shit that we cover when we're doing coursework and doing mentoring. But whatever criteria you have for setting these resistance zones, be clear that when you're looking at a profit target, it has to be a fairly strong resistance zone, because if you're looking at price as an entry, it's got momentum, it's got to go. So it may very well go 40, 50, 200 pips. It may be in a long leg before it really comes down. You may be into a runner. You always take into consideration the maximum amount that you think that profit target could be. And that maximum amount is where that medium to strong resistance zone exists. That's what's possible for price to get there, if it's going to be a good you're judging the momentum at take point. It will be able to get there based on your knowledge of price action of that particular currency pair to go 10 pips or 20 pips or whatever it is. Now there's some currency pairs that go, the 1 minute is 20 pips, okay? Where in the majors, a 1 minute tick might be, I don't know, 2 pips, something like that. 5 minute chart might give you a 5 pip average to range. So you're looking at this profit target, and you're looking at the time that your price action is moving at, and that's a factor of velocity. The time rate of change of the velocity is an acceleration, but if you're just changing that velocity from a normal kind of moving around to maybe you're doing a breakout, for example, you're getting more velocity during that breakout. That velocity will create momentum, because momentum is mass times velocity, and so you've got those two components that go together. I talk in terms of momentum, which is a physics term that's more appropriate than a lot of the folks using as velocity. You don't really care about velocity. You have something moving really fast, but it has no punch to it, right? So the profit target represents what you're estimating as a terminal point for that price momentum to hit. Now that could change, and it could change into a runner. You don't know that. All you can do is plan on, well, what's going to happen for that exit. So you've got your parameters set up for a profit target. So you're either going to take the profit target, or you're going to look at momentum prior to it getting there, and you're going to say, geez, I think I'm going to pull that limit order, and I'm going to sit here and I'm going to watch that thing go through. And then you need other rules to handle what you're going to do as soon as that thing goes past the profit target. I mean, then you could go into staging and some other things that that are appropriate for doing that. Well, once you establish that profit target, though, you have another set of considerations that has to be in your rules. What do you do between the time that you enter the trade and it gets to that profit target? Are there conditions that you can think of where you would like to get out of that trade, or where you feel that you need to get out of that trade? That's when do you exit that position. When you have the decision to do that. Not when, oh, I'm going to walk away and go take a dump and I'm waiting for my price to hit my profit target. I have a position on right now. It was way against me. It's over the last day. I did a carry trade with it last night. It's back down. It's only a little bit underwater right now, so it's probably going to turn around and move in my direction. And the conditions for the trade haven't changed as far as where my profit target is set and where my danger zone is set. So I'm just out here having a cup of coffee, talking. I'm not going to worry about it. I'm not going to worry about a runner because I'm getting a maximum run for that particular position, because that's what I was in my plan when I took the trade originally. It didn't work out. It ran against me. I had enough faith in the trade that I thought, well, I'll just manage it and let it go. In fact, I did, and I added to it in a negative sense. But if it gets to my take point, my exit point, profit target, I'm more than happy with that, even though I might be able to get more out of it, but because I've added more to the position, so that when I hit that profit target, I make more money than I had originally planned to make, and I was going to be happy with that at that take point. So when do I exit that trade? I'm going to exit it at that original profit target where I did all my research that was there. So that's the sort of research, that's the sort of thinking that you probably should be doing. And if you don't know how to do that, I'm afraid you're not going to find it in a book. You'll probably have to find somebody who does know how to do it, number one, and number two, knows how to teach it. And then it isn't just taking 3 hours of a person's time to do this, to what I'm talking about, or 20-minute video, because it isn't just this topic. It's all the topics around it that support that. What was your entry analysis like in order to put you in a position where you had these kinds of decisions to make? What was your position management situation? What rules that were going to support the trade entry decision that was made? And what exit methodology are you using that might be conducive just for this particular currency pair, or because it's Tuesday or whatever, that it might not be appropriate on another currency pair another day, whatever those conditions are. You can't just ask one question. When I work with somebody initially, when we're chatting through email, I'm happy to answer questions, no charge or something like that. But what generally happens is I get a question and I'll give them a good answer, because that's what I do. I'm not trying to get anybody to sign up for my courses. God, I don't want to be that busy. I'm retired, so I'll work with a few people a month, maybe. If enough people would show interest, that's fine. But I'm not going to do more than that, because my time is more valuable than any money that you can pay me. So I try to help people the best I can. But here's what happens. I get asked a question, I email them back with the answers and some surrounding information. Then they ask another question because that wasn't enough information. So I say, okay, well, here's the thing, and then they come back and they ask, well, what if this happens and it happens? And I try to paint a bigger picture for them. And they come back and they go, well, you know, I've been doing this, but what happens when you do that? And I go, whoa, wait a minute. You're not asking questions now. You're asking about methodology. And you can't solve a methodology by asking questions. You have to have a methodology presented to you so that you can decompose that and figure out how you would construct your own methodology. And that takes a course or mentoring, or it takes what I call process-oriented trading. You have to have a process for everything that you do in your trading. You can't just randomly go out and say, oh, I don't know how to get out of a trade today, so I'll go watch Peter's video on when to exit a currency position, and I'll know how to do that. No, I said, it's going to do you any good. I can do 10 videos on that. It ain't going to do you any good. And you can take one of these online courses, and all they do is have videos there. It's not going to do you any good, because the person that's teaching that has a different view of it than you do. And you have to be able to ask that mentor questions. Why do you think you go to school? Why don't they just give you the textbook and then you take the tests? You could probably pass the tests if it's based on what you're reading in the textbook, but what's in the textbook doesn't give you the information to do the skill. You need a mentor. Would you want to learn how to sail by just reading a book? Or, I've been in martial arts for over 50 years. And there's all kinds of books. This is how you do martial arts. This is inside, outside block. This is how you do an up block. This is how you do your punch. This is how you close your fist. You read these books. I get these people that come into my club all the time. And they show me how they're punching. And, the best way to punch is with your thumb up here like that. I go, where'd you learn this stuff? Who taught you? Well, I didn't. I learned it from a book. It's a master, and he's showing me all this stuff. And I watched his videos. Well, you don't know shit. And you know that. What you're going to do, read a book and watch a video while driving a car, and then you're going to drive that car on an expressway for the first time? I don't think so. And so, when you're looking at major problems like this, major issues, don't try to make it up on your own or do it in a book. Find somebody you can trust that can help you through that, because it'll save you not only a lot of time, but it'll save you 10 times over whatever the fee is that they're charging you to do, because you've got those skills then for life. Of course, if you have shitty education, your results are going to be shitty. So you're losing money in the trading, and you lost money by paying the person educational fees. You really have to understand the educational process. If you really think that you could go out on the street with a high school education and get a job as a senior software engineer just because you've been programming for 10 years on your own, video games, that isn't going to happen, because you don't understand the programming process within the construct of the analysis and design and all the rest of this stuff. It takes time. So if you're not willing to invest your time, and if you're not willing to invest your money in taking a legitimate course or program, then you can go ahead and keep trying this stuff on your own, and you trade a mini account, you get maybe $3,000 you're trading, or $500, and you're wasting your time trying to learn how to trade on those small accounts. It doesn't work unless you've got somebody behind you working with you. If you think you're just going to learn on your own by trading these small numbers, you're delusional. Take that same thing, take those 3 mini accounts that you were trading and start trading 3 fulls or 5 fulls. Your balls will shrink up and fall off, and so will your bank account before anything happens, because it's different. The environment is different. Your mind is different. Look in terms of process. So if you're running into a problem in your training and you don't understand why that's happening, then what you need is process. Not the solution to that problem, but you need a process around it for most problems. There's a lot of problems that I could solve in email, or maybe we get in a video conference call or something, and we could talk about it and go, oh, yeah, have you thought about this, or have you thought about that? And because of your experience and the other things that you have in your life, you'll go, oh, yeah, now that makes sense, let me try that. Now, that may not work for you, but it opens up a door into the realm of possibilities that kind of suggests, that suggestion that I gave you could lead you on, and then maybe you can go and figure it out, or maybe you send me another email and say, well, that didn't work, but this is what I'm thinking. I go, yeah, maybe try that. Or maybe what I'll say is, nah, I think you need more information than just where you're going to. I think you're lacking something in your background, and I don't know what that is. That's why when someone is looking to train with me, I send them a questionnaire form. It's about 20 questions: who you are, what do you do for work, how old are you, you know, what's your view on risk, do you understand a little bit about probability, do you understand advanced principles of trading, where are you at in your trading. So I get to know the person. So because it's easy, and I have this in the show notes for every one of my videos. Send me an email, tell me a little bit about yourself, because the answers that I could provide for you, if you're a 50-year-old, are going to be different than the answer I might provide for the same question from a 20-year-old or a 25-year-old. I mean, that just makes sense, because the experience of the person is different, and the stuff that they've done is different, and their fears and their goals and all that other stuff are different. And so when you're looking at something like, when do you exit a position, it's easy: when it hits your profit target or when it hits your stop. Case closed. There's your answer. But I hope you see that there's more nuance to that based on what I've presented in this video. I'm not real sure that it helped you. I'm not really sure that it answered the question, when do you exit a position? But I think, hopefully, it's educated you in looking at a broader process than just one specific thing, because the one specific answer isn't going to do it for you. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.